Welcome to Startup Canada Live Startup Foundations. Today is Thursday, April 27th. My name is Janice McDonald and I am the Ambassador for Women Entrepreneurs in Canada for Startup Canada. Startup Canada is the national rallying community and voice for Canada's entrepreneurship community.
And my name is Brandon Waldenuk. I'm a product manager and venture partner with CoVenture, and I'm here working with Startup Canada because of the work they do in the community. We are your hosts for today's show. We are, Janice from Startup Canada's national offices in Ottawa, Ontario, broadcasting from cubicles, co-working spaces, incubators, and startup communities across Canada.
Every Thursday on Startup Canada Live, we discuss topics relevant to Canada's startup, scale-up, and small business community. We feature expert guests to provide insights into funding, growing, and scaling successful ventures. Startup Canada Live is streamed through Periscope and Facebook Live for easy viewing wherever you are via our good friends at restream.io. Startup Canada Live is brought to you by Intuit QuickBooks, Canada's leading provider of business, financial, and tax management solutions for SMEs, and by Mastercard. Whether you need a card for purchases or you need payment solutions to help you manage and track expenses, Mastercard has the right solution for your small business.
Today's Startup Live topic is building blocks of credit. We are joined today by two special guests. Our first guest on today's episode joining us is serial entrepreneur DANIELLE KADHIT of Big Fit Strategy. DANIELLE is a numbers-driven storyteller working to support small businesses become more profitable through productivity. Also with us for today's episode from Toronto is Adam KADAR, Director of Credit and CCO of Lending. Adam earned 10 years of experience in the banking industry before joining Canada's first fully regulated peer-to-peer digital lending platform. Welcome to you both, and thank you very much for joining us today.
For those of you tuning in, you can ask questions anytime using the hashtag StartupLive on Twitter or by commenting on the Facebook Live video. So, we've got great panelists, and we're going to start things off with something that, Brandon, you got us all hooked on, which is, what's the most interesting thing you've done in the past 48 hours that isn't work-related? So, Danielle, why don't we start with you? This is a great thing that Brandon's got us hooked on. So, what have you been up to?
So it's semi-work related because it was a result of something work related, but last night the weather in Toronto was pretty nice in the evening. So my partner and I celebrated an exciting business milestone by grabbing drinks on a rooftop patio.
Congratulations.
Nice.
Adam, what have you been up to?
Mine is food related as well. Just grabbed some sushi and caught up on some Netflix actually.
Love it. And Brandon?
I returned to Ottawa to find my condo was not finished being repaired. So I'm on a floor actually in the wonderful Prince Edward County, sitting at the restaurant called the Schoolhouse, which is an amazing, amazing place. So I will be enjoying excellent food in about an hour.
That sounds good. After we're finished this. So for me, mine, I can add a food part to it. I was at the Women in Communications and Technology Gala last night, celebrating amazing women in that industry, and so I had banquet food, and it was fine, and it was a fun night. So we've got lots to talk about. Why don't we jump right in? So why don't I grab it? Oh, okay, go ahead, Danielle. Okay, are you going, Brandon? We got to work this out since we're not sitting beside each other. All right, off you go.
I was going to say, our flow is just off. So Danielle, can you please explain how you're telling stories with numbers? What can entrepreneurs gain by better understanding the numbers associated with their startups?
So I like to tell people that finance doesn't have to be intimidating or boring admin that is just receipts in a shoebox or the cloud, only to be dug up at the 11th hour of tax time for your accountant. I think of numbers as the living story behind your business, and it should be an ongoing one to read into. So the language of accounting can be confusing. I like to take an intuitive approach and help business owners visualize the numbers that matter and walk them through the meaning behind things. So I do this by developing custom reports and approaches that help them to better understand what they need to monitor. And one of the things that came up early on when starting my business was the need to create a solution for this. So I'm currently building a web app with my partner called Cost Canvas that will support financial management from this intuitive approach without even needing to scan through a spreadsheet. So in terms of what there is to gain for entrepreneurs, I think it's super important to find a great accountant, a finance manager, or a CFO. But at the same time, as a business owner, you need to be able to read into the numbers and really understand the things that are driving your business success.
Excellent. And Adam, can you explain to viewers what peer-to-peer digital lending is and why you made the move from a bank to a fintech startup?
Sure. So I want to break your question into two parts. First and foremost, the digital lending in the peer-to-peer fashion. So in terms of that, what we mean by digital is that the actual application process has been digitized. So instead of physically going into a bank branch or some sort of office to submit a loan application, our entire process is online and digitalized so that applicants can, from the comfort of their home, their mobile device, what have you, submit an application for a business loan in less than 5 minutes, and then just upload some supplementary documentation whenever they get the chance. And within 24 hours after they complete that process, they essentially find out if their loan is approved.
That's impressive.
So that's digital.
Wow.
Yeah. Thank you.
Easy and fast.
Yeah, I'll let our CTO know. He's been working very hard on making this process very quick.
That's amazing.
So that's the first part.
Yeah.
The peer-to-peer aspect essentially talks about where the capital actually comes from. So everyday Canadians, like you and I, like the listening community, is exactly who fund our loans in portions essentially as small as $25. So it's a crowdfunding solution, and the crowd funds these loans. So it's very much Canadians helping Canadians. So that's the first question, I think.
Yeah, and why did you move? Why'd you move from a bank to a fintech startup? What was the pull for you?
I actually had a brief 8-month stop at a provincial regulator before going. So there was a brief stopover, but I don't know if there was necessarily a specific pull. I essentially grew up at a bank, spent almost 11 years there, but I really wanted to find an environment where I could leverage all of my previous experience at a bank, but be on the forefront of technology and innovation. So that's what drew me to Lending Loop specifically, because I can leverage all my previous banking experience while sort of, as I said, being at the forefront of innovating financial technology.
Amazing. That's really interesting. To expand a little bit more on these loans, though, I'm pretty interested to understand those loans that are issued are of varying types, because there are many different types of loan categories. So is there like a high APR for them? They match similar to other lower APR things? Are they all bonded to a company? Do they require principal or an asset? How do these loans operate that you're giving?
Sure. So the loans range in size from $5,000 to $500,000. Our sweet spot has so far been in about the 20 to 150 range. As these loans are crowdfunded, the size of loan we can do depends entirely on how big our community actually is. And right now they're able to support about a $150,000 loan comfortably. Interest rates on the loans range.
I missed some of that, so maybe you could, sorry, just to jump in for a sec, Adam.
6.5.
Oh, we're having some technical difficulties. Yeah. Okay, we're facing a few little challenges here. Just when we were getting to the good stuff from Adam about how much it's going to cost to lend. So maybe we can try that again. We lost you when we started to hear what the percentages were.
Oh, sorry. I think I got disconnected for a second.
That's okay. We lost you, Adam, when you were starting to tell us how much it would cost. So if you could just pick back up the point where you were giving us the interest rates.
Sure. The interest rates on the loans range from 5.9% to
5.9 and up. That's what I've heard because I couldn't hear the rest of it.
Yeah, let's maybe try a different approach and ask Danielle while you get that figured out, Adam.
Yeah, great idea. All right. Danielle, do you want to talk to us about personal credit?
Yeah. So personal credit, it's attached to you as an individual, and it's your personal credit. We're talking about business credit here, and it does affect your business credit if you're applying for a business loan, because they will actually read into your personal credit. So developing a good business credit is intrinsically linked to also being aware of your own personal credit score, as it is something that is factored into the process.
Do you want to maybe just break that down and walk us through that? Because I think a lot of entrepreneurs aren't necessarily thinking about it. Do they understand their numbers? Do they know what a good number is and that kind of stuff?
Well, there's the 3 credit business bureaus that offer all of the credit scores that you can look into. And there are many factors that are tied into what exactly your personal credit score are. So there's things that are factored in, like how many loans that you have. And
well, are you still there, Brandon?
I'm still here as well.
Oh, Adam's here. Okay.
We've regained Adam, and yes, I am.
Oh,
We're
okay.
playing musical chairs with our internet connection.
We seem to be.
It's
yes.
very lovely.
So
I thought it was because I was talking about interest rates that the call just magically disconnects.
That's
exactly.
absolutely correct.
I'm
Even the internet doesn't like numbers.
Oh,
No.
I know. All right. So if we could, Adam, you were giving us the interest rates. Then we'll hear, if you can finish your thoughts on that, then we'll jump back to Danielle and the insights she's sharing on credit scores and how it differs. So could we maybe pick that up back with you, Adam?
Sure. Maybe I'll just blank out the interest rate part so the call doesn't drop. But essentially, we stratify our loans into 10 categories that encompass rates from 5.9% to 26.5%. And this stratification is essentially done by assessing the business's credit quality, the credit quality of the guarantor, and looking at things like various financial metrics that we'll discuss probably later today. And the purpose behind the loan and what security they have to provide. And
meaning, so purpose would shape outcomes. Can you just explain a little bit more for people that are tuning in?
Yeah, absolutely. So there's a multitude of reasons why a business might seek financing, among those financing a piece of equipment that they're purchasing, some sort of general working capital need that they might have. They might be buying a facility, doing some sort of leasehold improvement. They might be refinancing existing high-cost debt. So they might be buying out a partner. So there might be a multitude of reasons why they might seek financing, and sort of the inherent risks associated with these transactions all tend to be somewhat different.
Thank you. Brandon?
Thank you very much for the response. Pretty interesting. I've played around in the lending space for a while, so I will try to divert from getting into the nitty-gritty for the sake of the audience, but it's a very cool business, and I look forward to talking more about it with you, Adam. Sure. And I also eagerly await the discussion with Danielle about the difference between personal credit and how you can develop that, and then relation of business credit to personal credit. So try to pick that back. That'd be fantastic.
Yeah, so going off about the credit score, in Canada, it's a 3-digit number, and you have between 300 and 900 that they calculate based on how worthy you are for your credit. So they use it as a measure of how willing they are to take on the risk of giving you a loan for your personal or business finances. So whether it's a mortgage loan, a car loan, or if it's startup capital, depending on certain factors such as your ability to repay, carry a balance, pay on time, and all of these different things that we'll get into later on in the questions. Your credit score is affected by all of these different factors.
And what typically is the score that most people have? What's sort of the standard? I know you gave us the range. We know what bad is and we know what good is, but what's sort of typical?
I wouldn't be the person to answer this question because I know what my score is and I know where I land among other people, and apparently it's a really good one.
Okay.
But I defer to Adam for the typical average if he knows it at all.
Yeah. So I think the important thing to understand with credit scores, I think the average is somewhere around the mid 700s. It's small business owners and operators or entrepreneurs in general tend to have a different credit score from that just because of how they tend to finance themselves and how their life runs versus in contrast to someone who, for example, has a 9-to-5 job at a bank like I did. Their life and finances are structured a very different way that inherently will have an impact on their credit score.
That's very helpful.
So in short, you shouldn't stress too much about it. Important to be doing is to build your credit. Yeah,
I mean, there's not many things in life, I guess, you should stress too much about. The credit score, luckily, is something that within a relatively short amount of time you can realistically fix. As Danielle mentioned, sort of the inputs into that credit model, if you were to change your behavior associated with some of those things, it would have a meaningful impact on your score within a reasonable amount of time, so 3 to 6 months even. So definitely not worth stressing over.
And can you just highlight what some of those meaningful steps you could take to provide different outcomes would be so that people understand if they do have a less than stellar number that, first of all, there's hope, so they can fix it relatively quickly, but if you can outline briefly for people to understand what they can actually do.
Yeah, absolutely. And Danielle, feel free to jump in anytime. A lot of the things that we see, or that I see specifically when looking at people's credit, is small business owners, for example, tend to have a lot of different credit products. They open a new Visa card, for example, for their business to run the day-to-day expenses out of. They have another Visa card that they use for major purchases.
Sorry, we're losing you there. Danielle, are you there?
Yep.
Can you jump in where Adam was?
So we were talking about factors that would improve your score?
Yeah.
Actually,
oh, it's a comedy today. Danielle, do you want to take over there?
Yeah, so some of the things that also affect your credit score and being able to improve it. So the primary one is the ability to repay on time. Mm-hmm. So typically paying your minimum balances at least, or paying early, or paying in full. And then making sure that those payments are no later than 30 days is one of the things. Okay. Another thing is your credit utilization ratio. So basically, if you qualify for a $10,000 credit limit, are you maxing out your debt? Mm-hmm. If you are carrying a balance of a ratio between 20 to 30%, that's usually suggested. That's one of the things that they take into consideration. So if you're lucky enough to qualify for many different loans, try to balance out your usage ratio between the different credit cards or loans that you do have in order to improve your credit utilization ratio.
So meaning if everything's maxed out, it is bad?
Yes.
Okay. Adam, have you returned? Perhaps not. Brandon, you're still there, I hope.
I'm here, holding the fort. I can talk about it too if you'd like.
Please.
I think one of the things Adam was trying to get at earlier too was it is a red flag for people to be opening too many accounts at once. So I did mention a strategy to balance out your load. But if you are opening several accounts at a time, that can raise a red flag and really also hinder your score as well.
Okay, that's helpful. So Brendan, if you have some additional comments you wanted to add to that.
I don't know about these instances, but one of the things that are looked at often is the total value of your outstanding debts when taking on certain types of loan categories. So, I mean, most notable but not super relevant here, I think, would be a mortgage. So if you have a personal line of credit of $25,000, they kind of just assume in that mortgage application that $25,000 is maxed.
Okay.
So in certain situations, when you're developing the early personal credit, and say for likely the younger population, so let's hope there's some 16-year-old entrepreneurs watching right now, you do want a credit card. You probably want to keep it to a $500 or $1,000 maximum and hold that for a while. And as Danielle mentioned, keep it in the 20-30% utilization range. You get off every month, and you'll develop excellent credit. And when they try to push it up to like a $5,000 max, just to know.
Okay, that's very helpful. So what do entrepreneurs need to know about credit before incorporating their business? And we've heard a little bit about good and bad credit, but how might it affect this step? So Adam, have you returned?
I have. I've actually, I think, switched to my mobile hotspot data. I hope this is better.
It is. It's great. I'm sorry that we lost you there. So we're now talking about credit and incorporating your business, but if you want to go back and finish any thoughts you had.
I'm not sure where it cut off. I feel like it's funny. Anytime I mention a rate or number or the word credit, I feel like it's...
So maybe you could refrain from that going forward. So
we can go back to the sushi conversation. I feel like that was quite positive.
Yeah. It's a tragedy in 3 parts.
But okay, credit and incorporating a business. What do people need to know when they're ready to make that next step? Do you have some advice you can give us, Adam?
Yeah, absolutely. I don't think personal credit will impact the actual process of incorporation. I think the decision to incorporate a business is very different from sort of any other thing that we've been talking about before, and I can sort of add to some of the relevant reasons. A lot of it might have to do with managing liability, separating that business from your own personal finances, or own personal life, what have you. Adding a partner, things of that nature might motivate the actual incorporation process. I'd say credit has an effect on the business itself because it might make the ability of that business to stand on its own 2 feet, financially speaking, a little bit harder if you have poor personal credit.
Yeah, I'd just like to jump in and add that when you're incorporating your business, that particular structure means that you're creating a separate entity from your personal entity. And that's really the big thing to think about. Credit is one thing that you can keep in the back of your mind if that is going to be a financing strategy for your incorporated business. As a sole proprietor, you could still have a business credit card, but the liability and the risk will go on your personal credit report as well. Whereas it will affect your business credit and it will go on your corporation's entity when you take on a business credit card or credit loan, particularly for your incorporated business. So if you're actually thinking about obtaining a loan as part of your financing strategy, it's something to think about incorporating in order to mitigate your personal risk.
Brandon?
Yeah. Sorry, I think I got a bit of a couple second delay.
That's okay.
But excellent point. I appreciate that feedback. Another piece that I think is pretty important is to try and understand what banks, investors, other financial institutions are looking for entrepreneurs for putting a loan. And now I wanted to break this down because those are many, many different types of categories, and some of those would need to be considered a loan asset. So first, if we can win here and maybe I'll ask you about numbers, Adam, what are banks and other financial institutions for when they are approving a loan because of your experience?
Yeah, absolutely. Most financial institutions will usually start by having a personal credit score threshold below which they will not lend to that business even or that individual. It tends to be around the mid 600 range. Some have a minimum of 625, some have a minimum of 650. Essentially where this limit comes from to begin with is that there's actually a probability of default or probability of delinquency associated with a particular credit score that some rating agency has determined. And the bank's appetite to lend to that person or a person with a score below that threshold is very minimal because it represents just a risk that's too big to them. So they don't choose to do that. In terms of what they generally look for and what these sort of interest groups look for, I think the important thing to consider is what people make out of a credit score. So a person's credit score usually demonstrates their ability to be diligent with their finances. It usually speaks to their character. It usually speaks to their ability to manage whatever cash flow they have in their business, and just to be proficient in whatever it is that they're doing. So I think that's what banks look at first and foremost when they start with a person's credit score. But some of the other things they might look at is trying to figure out, using whether it's the company's financial statements or some other metric, is what is the business's actual capacity to take on that debt. So they might look at things like their cash flow, for example, and see how much debt they can actually afford to take on. The other things they might look at are what type of collateral is being pledged for that loan. So for example, when you take out a mortgage, they're really lending against your house in a worst case scenario. Obviously, it's your income that's supporting the payments, but really one of the things that would be key in that situation is look at the actual value of the underlying home in the event that you wouldn't be able to make the payments. So from that perspective, collateral in general is very important. In a business context, that collateral might be a company's inventory levels. So for example, if your inventory is perishable, that might be very different than someone's inventory who is not perishable. The other things they might look at are accounts receivable. So if people owe your business money, who are those people? Do big companies owe you money? Do small companies owe you money? How collectible is whatever it is that's an asset on your balance sheet? So these are just some of the things they might look at, but essentially they're trying to assess that business's ability to repay that loan and how much extra security is available in the event that it doesn't get paid back.
Thank you for that. I really appreciate the response. And one other category that I think a lot of people don't think about is the loan to value ratio of most of their goods. Can you speak a little bit about the LTV?
About loan to value specifically? Sure. In a mortgage... Yeah,
just help break it down for listeners.
Yeah, so in terms of loan to value, what people are trying to ascertain, or what institutions are trying to ascertain, is the size of the loan they're willing to give you in relation to the asset that you happen to be pledging. This calculation is particularly obvious when you take out a personal mortgage. Your mortgage is measured as a function of the value of the home you're buying, usually as a function of the purchase price or appraised value, and that tends to be around 80% for personal mortgages. But in a business setting, you'd likely have similar calculations, whether it be a function of the purchase price of the business or as a purchase price of, or as a function rather of the asset that you happen to be purchasing, whether that's a piece of equipment or what have you. Banks would also place similar metrics in terms of loan to value on that too. So banks and other financial institutions would generally be looking to you to contribute a meaningful portion of that purchase price, as that tends to buffer their risk as well. So I would definitely urge individuals to have some expectation that they should be prepared to contribute at least a portion of the purchase price of whatever it is that they're trying to finance as part of that loan application.
Perfect. I appreciate that. And Danielle, I'd just like to turn a similar question to you. And if you respond to some of the investor side as well, I mean, feel free.
I want to share a funny story about character when it comes to applying for loans. My very first credit card when I was 18, I was raised from a family that thought credit was bad, and I was warned against it. And I just went out and marched into a bank and got my first credit card. And I thought that the way to do that was to dress the part. So I thought it was super cool and professional with my blazer and my dress pants. But these days, you can qualify for a loan overnight online. With all of the boom in the fintech industry, lenders can scrape several databases online, not just credit bureaus, to make their lending decisions. So make sure you can position yourself well in your industry and monitor your cash flow in order to qualify. have a plan, have a purpose, have a solid business case, and what the money will be used for, and also a plan for repayment, which comes in with your projections and your cash flow and your sales. So lenders, as Adam mentioned, like to see skin in the game. So put your money where your mouth is. Some loans you can apply for want to see matching. So that means that if you qualify for a $60,000 loan, I know the Smart Seed Fund, some of them you might have to match that with other investments, 30K, for example, or some investors actually want to see that you're serious about this business, you're working on it full time, you're using your own capital to fuel it before you go out looking for some of theirs. So those are some of the factors I like to think about as well.
And could I just ask you a follow-on question? So you said that they're scraping other references or sources. What would be some of the other sites or sources that they're scraping to get the full financial picture of their potential lender or loanee?
I'm not personally privy to those, but I did read up that it's not just the credit bureaus. There are certain algorithms that some fintech companies have used to look into kind of like your digital footprint, looking at the legitimacy of your company and different things like that, just in order to make a decision.
Okay, thank you. Anything further on that, Adam, that you want to add?
Yeah, I think I actually got cut off in an earlier question, but I wanted to, I don't know which question I'm adding it to, but I wanted to add it anyways. Personal credit is also extremely important for lenders of any kind, because very often, especially with early stage companies, or if you're trying to raise funds from angel investors or what have you, is you will undoubtedly offer or be asked to offer some form of a personal guarantee on whatever credit facility that you take out. So as Danielle mentioned, in terms of skin in the game, a personal guarantee is exactly just that. You're basically pledging your personal resources to backstop any loan that your business does take out. So dressing the part, doing the research, all the things that Danielle mentioned, extremely relevant, because financial institutions will undoubtedly ask you to be heavily involved in supporting any credit that they may grant you.
So are you jumping in now, Brandon?
No, please go ahead.
Okay, so next question. What are some of the business best practices or strategies you've learned for maintaining business credit? And I guess more importantly, for people viewing, what are any pitfalls to watch out that could damage your credit track record? So Danielle, could we maybe start with you?
Sure. This is where one of my favorite things, cash flow management, comes in handy.
Okay.
Actually monitoring your money ins and outs is key once you secure business credit. So ensure you can cover the minimum payments and that you pay them on time, so no later than 30 days. Mm-hmm. If you can, automate that within your bank account so you can at least make the minimum payments each cycle automatically. If you're in a bind and you can't pay, rather than wishing it away, you should try to establish good rapport with your suppliers and your lenders if possible. So you can negotiate a payment plan. It'll go a long way rather than ignoring it and always paying late and hoping that they don't notice, because eventually if the patterns keep up, they will. Mm-hmm. The strategy that I talked about earlier is to think about your credit utilization score. So for me personally, if I qualified for a $10,000 loan, I don't try to max it out if it's for working capital. I try to only spend within 20 to 30% of that particular loan's limit. If you have more than one credit account, you can balance the load out between them. So yesterday I qualified for a credit increase, and of course I took it, not with the intent to max it out, but to up my possible usage ratio. So if you aren't approached by your bank, inquire for a higher limit after making timely payments and demonstrating good credit to up your limit and reduce your ratio. So yeah, but on the flip side, don't open too many accounts at once, because again, that raises a red flag. So while it's not a bad thing to have more than one credit card or loan, it's actually a good way of balancing out your credit usage, because it can be a red flag for lenders.
Excellent. Adam?
Yeah, just to add to that, in terms of cash flow, I think what a lot of operators have a hard time separating is understanding that profitability doesn't necessarily mean cash flow. And I think that's one of the things that causes them to sort of go down the wrong path. So a lot of them are seduced by earning a positive profit on whether that's providing a service, whether that's selling a good, or what have you. They sort of stop at saying, I've made a profit on this, and don't really take it to the next step. But really what they have to ensure is that their business has adequate cash flow to actually service whatever debt it is that they take on, ideally, obviously operating at a profit, but they really need to ensure that cash is coming in the door regularly in order for them to manage relationships with their suppliers and or creditors.
Excellent. Brandon?
And yeah, to build on that a little bit more, that was an eloquent response. I'm going to just filter it down in a bit of a different way. There are people in the world who have businesses that make a month, let's say $10,000. But if your cash flow is poor, you could hit a moment where you actually can't pay your employees because of the fact that you don't have the funds in the bank account at the time that the bank account needs to clear the check to pay the employees.
Right.
So a lot of people don't recognize that the business, wow, it's $2,000 a month. But if you're not actually in an accounts receivable way, it's just such a critical point, especially for entrepreneurs, to know the difference between a cost of goods sold, net profits and revenues, profits in the middle, and then this cash flow. It's an excellent point to raise, and I think that's important, and it will affect your ability to generate loans or other credit faculties, I'd say.
Danielle, anything to...
If you want to build on that, please go ahead.
Yeah, I was just going to say, Danielle, is there anything you want to build or add to that before we move on?
No, I think that was really good. I really want to drive down the point of once you get the credit, you should have a plan, monitor your money. Cash flow management is super important, and always making sure that you create realistic projections and understand what your runway is so that you can plan in advance.
Thank you. So things go wrong, we know this. So and maybe you have some examples you can offer for some people that have run into some obstacles around business credit. Did they negotiate? You referenced that earlier, Danielle, or how did they kind of solve their problem without, and still keep the business moving forward? If maybe you could start there. I'd love to hear from all three of you. I'm sure, Brandon, you have some examples that you could share too. So, Danielle?
Yeah. Personally, I'm a bootstrapper, and I obtain credit, not when I need it, but just in case for a rainy day. But I have guided entrepreneurs looking to secure major bank loans and have asked me to review their business plan and their financial projections. And projections are powerful tools to supply your application, but if they aren't grounded in reality, then they aren't really going to help your case. So I'm a fan of projecting scenarios and really putting research into your financial models. So don't be naive and say that your business will have 10,000 users and sales overnight if you don't have any traction yet. So one business owner I worked with was running a very risky venture that required lots of capital up front and was turned down for all kinds of loans. So from that failure, we entrepreneurs, we like to pick up, he scrapped that idea and learned what to do better with his next business idea. So one of the things he did in his next loan application was connect with someone who could check his values, his financial projections, and suggest ways to strengthen the business case. So if you can, work with a business mentor or someone with finance savvy who can gut check your projections and steer you in the right direction.
And one of the things you mentioned earlier was around having that relationship. So, and you talked about getting credit before you actually need it. So I do know for our national study on women entrepreneurs and their approach to risk, one of the things we heard that was so important was the whole idea of having that relationship with your funding partner, and having that comfort level and that they understand your business well before you're coming in and asking for money, so that you're going in early and creating trust in a conversation at the beginning.
Yeah, absolutely. And I think it even goes beyond to before you even have credit, if you can start thinking of some really good trade references. Sometimes if you're looking for credit with any kind of agency, they will ask for trade references. So having those handy and knowing who you have really good relationships with, who can vouch for you when you're really looking to get those big loans, will be a handy thing to have.
So I think that's a really powerful takeaway for people to understand that you do need trade references, and you should be thinking about those and cultivating them and having them in the ready position for when you do actually need them. Adam, thoughts on this? Some horror stories or successful outcomes that you could share?
Yeah, I think Danielle hit the nail on the head in terms of realistic projections. I think any lender wants to understand that business owner or operator understands their own business. And I think it can create a lot of mistrust if those numbers don't portray, or at least aren't seeming to portray, a realistic reality, a lender will feel very uneasy if they have the impression that the business owner doesn't understand what it is that they're doing or doesn't have a realistic grasp on their own business, and will probably be more haste in terms of their own decisions should some sort of an obstacle or credit event type of thing happen. So I completely agree with Danielle in terms of that. The more realistic you are in terms of your facts and figures and projections, and the more you can convey your understanding of your own business, the more patient a lender will likely be with you. In terms of paths or ways around this, I think there's sort of two general ways that I've seen, or I guess three. The first one is some business owners tend to think that the solution is some form of ultra high cost debt. There's basically business equivalents of payday loans. So these loans have APRs that can go as high as 60%, and not many businesses have margins that can actually sustain this.
Yeah.
And I think that leads them down a path that very few can actually come back from. But a lot of these business owners make sort of hasty decisions to try to solve a problem very quickly, and it leads them just down a path that they can't necessarily recover from. And partially that might be not understanding their own cash flows, like Danielle mentioned before, or just not having a solid grasp on the finances behind their business. So that's sort of one path I see them go down. The second path is a lot of them actually have an accountant, bookkeeper, advisor, or some type of sort of savvy, trusted individual in their corner, and they actually work together with them to face the problem head on and really understand what caused this problem. And when they know what caused the problem, they can take proactive steps to fixing it. And it does take some time, but if they're transparent with their lender, and if they're transparent sort of with themselves and honest with themselves about why they got here in the first place, I think oftentimes they can actually fix the problem. And there are some lenders out there like ourselves that are more than willing to work with those businesses that are having some form of difficulty that they can climb out of. So I think that there is a happy solution to it. In terms of sort of the final point of your question, negotiating, I think no lender, or I'm pretty sure no lender, wants to lose money on a loan or wants to see a loan go bad. Not only is it not a pleasant thing to see a small business or business in general not do well, but it's just not good for the bank's business or for the lender's business to see loans go bad. So I think it's in everyone's best interest to see companies succeed and to see loans get repaid. So in terms of negotiation, I would probably phrase it as discussion or renegotiating or restructuring. So, for example, having some flexibility in terms of what payments are required immediately, re-amortizing the loan, for example, to ease cash flow strain. So if they have, for example, 2 years remaining, the bank might be willing to extend that loan for a third year and sort of spread those payments out a little bit more. So I think these options do exist, but as mentioned earlier, the business owner certainly has to be very savvy and transparent in terms of their own operations and sort of be able to convey that message to whoever is lending the money.
Thank you. Brandon, did you have anything you want to jump in and say before we take some Twitter questions?
I'll just add a little bit more to great, well, more than two, but both are fine guests giving good advice. The one thing that probably the hammer on the anvil sort of thing about man, my analogies are bad today. The one I look at is sometimes in your company you hit a point that's really difficult, and the comment that came about futures is what's interesting to me. Is depending on where you are, and I'm speaking mainly from a venture-backed place because I raised venture capital and ran businesses in that category. A personal anecdote is we hit a very scary time. Flow was very poor, and we were not going to be able to pay our employees. However, we did have commitment from customers, and we did also have commitments from other investors for our next venture round coming up. But there was a 3-week delay between those cash in our bank account and us needing to pay our employees. So that gave a really powerful case to go in and negotiate a loan from our bank account. And all of the statements that were made earlier, we had established a rapport. We've been going in from the point with the first paid check or first investment check. So I valued at around $200,000. I tried to put it in a bank account, and they looked at me because I was poor at the time. And they're like, "Well, buddy, we're going to check this." To the point where, we had a great open conversation. They were excited, looked at the paper. They said, "Okay, we trust you." And they gave basically, I'll call it a bridge loan, but it lasted 3 weeks. So we paid a very small percentage on it, but it was very valuable. And everyone talked about is very important. It involves projections, futures, and guaranteed, yes, almost.
That whole relationship piece is critical, I think, and it can be at times overlooked or not understood, So we do have some questions. All right, first one. Will investors and lenders assume that if my personal credit isn't ideal, my business spending habits will be the same? So are they linked? Is that how they're seen by investors and lenders? Who wants to jump in? Danielle, in your view?
I'm not the one making those decisions, but I can say from my experience, my personal spending habits versus my business spending habits are very polar sometimes. And I think I do display different differences in the two, just because I am kind of more risk averse in my business, but I do take very calculated risks in the types of things that I want to invest in, and know that over the long run I can see what the return on that would be and why exactly I need to make that big investment. So that's personally from my experience.
Yeah, that's fine. Adam, are they seen as the same thing?
I wouldn't necessarily say they're seen as exactly the same thing, but I'd say it's going to be an uphill climb to convince someone that they're not intimately related, especially if your personal finances or your personal credit aren't properly managed. So if you, for example, had a bankruptcy in your life, or you, for example, had a consumer proposal or some sort of very significant credit event recently, it's going to be very difficult to communicate to someone that the way you operate your business is going to be materially different from that.
And for people watching that may not know what it means, can you define consumer proposal?
So a consumer proposal would be an instance where you would actually renegotiate or negotiate with your creditors to come to an agreement where you might pay them some sort of a fraction of what amount you actually have outstanding. It stops the interest from accruing, but it would actually prevent you from going into a full-blown bankruptcy, and you'd actually pay them out sort of a predetermined amount in return for them sort of forgiving you potentially for a portion of the outstanding amount.
Okay, thank you.
You basically, as you mentioned earlier, sort of negotiate with your creditors.
So that's helpful for people that may not have been familiar with that term. So we have some more questions on Twitter. All right. What's meant by the idea of a credit mix, and how would this affect my score? So what is a credit mix, and how is it going to affect my score? Adam.
Sure. So in terms of credit mix, what is generally meant is that there's different types of credit products that you can have. Even personally. So if you just look through your own personal products, many people have some sort of a line of credit. They have a Visa card, for example. They might have a car loan. They might have a mortgage. They might have a personal loan that's not related to a car or not secured by some sort of physical asset. They might have a student loan. So a credit mix, for example, would not only be a mix of these different types of products, but it might be more than one product of the same type. So you might have more than one Visa card, you might have a secured and an unsecured line of credit, you might have a car loan and another type of loan. This is generally what's meant by credit mix.
Anybody want to add anything else in relation to that question? Okay, do we still have another? Yes, one more. Here it is. How do I navigate the relationship with a lender when it comes to talking about credit? How do I navigate the relationship with a lender when it comes to talking about credit? Who wants to answer that? Danielle, you're
I'd
ready
love
to go?
to get more context on the question, but if it's a Twitter question, I understand you're limited by characters. So
It
I
is
will
a Twitter
infer,
question.
I will infer and say that honesty is the best policy. While you do have to position your character in the best way possible, it's totally fine to be upfront with your situation, but also be able to demonstrate that you have a plan in place for the future and be able to show that you know your numbers and that you are the right person to execute on this particular idea and why.
Okay, Adam, do you have anything else to add to that?
Yeah.
Please.
Yeah. I think one of the things that it's important to keep in mind that might not necessarily be obvious at first is credit, either from a personal or business standpoint, is very much like car insurance in the sense that different lenders have different appetites for different types of credit risk. So some lenders might have a high appetite for technology-based startup companies, others might be more asset-based lenders and things of that nature. So that conversation that that came from Twitter, I think one of the things that's important to figure out very early on is how receptive that lender is to your specific business and your anticipated credit needs. And that rapport is going to sort of change based on their answers to your advances. So if they're not receptive, it might be your cue to find a lender that is more receptive to your business and what it is that you are doing.
Thank you. We have one more Twitter question. And I will just say it is very important also to recognize that shop around, that just because you've been with one bank, of course you want the relationship piece and that's very critical, but there are other factors. If you're not getting what you need, look elsewhere. So one more question on Twitter. What advice do you have for young people to start building their credit and also to maintain good credit? Who wants to jump in?
Danielle or Brandon?
Yeah, I'd love to share a personal anecdote following my very first credit card. So when I obtained my very first credit card, I was scared about credit in general, and I thought I was doing this very rebellious thing. And my advice to young entrepreneurs would be not to be scared to establish credit early on and to actually use it. So one of the first things that I did was I first used my Visa card to pay for some sushi. There we go with the sushi conversation again. And then
Not getting disconnected, don't worry.
a funny thing I did was I went home immediately and I paid off my bill in full just because I was so scared about credit. So don't be afraid to use credit. Don't be afraid to carry a balance, meaning if you don't pay the entire amount all at once, it doesn't actually affect you that negatively unless you pay late. So don't be afraid to actually, once you obtain credit, use it, spend it wisely, pay a couple of things, have a couple of recurring bills on it, and actually demonstrate that you have good personal credit. And I also know that a couple of young entrepreneurs who are probably potentially paying off student loans, that's another big thing that a lot of entrepreneurs have concurrently, having to pay off student loans while also having to take on potentially a business loan. There are so many great programs out there for young entrepreneurs that Canada is promoting, and I highly encourage everybody to look out for those specific ones geared to you.
Thank you. Brandon, any thoughts?
I was going to say, does everybody just assume that I have mistakes that I've made?
No, just because you talk to so many entrepreneurs, you typically have stories that... So I just thought maybe you had something to add in there.
Of course. I mean, I think it's a similar line. Like, don't be nervous. I've met, and we've met, my firm, many people from many backgrounds, and you can come back from anything. I've bankrupted personally 2 companies. I've succeeded in a few other ones. It doesn't stop you. I mean. Like up his name very often, but there is a certain resident who's bankrupted a few times who happens to be in power right now. So it's kind of one of those. The biggest thing that you can do, I think, is to try to remove the topic we have for some reason in North American culture, but talking about your money, which also includes talking about salaries. I think that lends itself back to Canadian women entrepreneurs as well, and a bunch of the other important factors around that. But understanding that everyone in this world has an intimate relationship with money, and that doesn't need some weird closed off topic that you share like secretly in basement speakeasy or something. Like, just talk to your partners about it, talk to your bankers about it, and as you mentioned, shop around. you'll find all sorts of people, and this is all every category of business. The investor from a venture capital firm through to angel also has a different appetite, and we look at different asset classes. So it's a wide world, and it's full of a lot of money, and you can figure it out.
I love it. Adam?
Yeah, I'd just say in terms of credit, the one thing to keep in mind is when used for good, as specified by both Danielle and Brandon, certainly I think it's a very valuable tool to operate either your personal life or your business life. But as a general rule of thumb, make sure you're living within your means. So when you take on credit, whether that's a loan, line of credit, credit card, what have you, make sure you have a plan and a contingency plan to pay it off. If you're taking out credit and you don't know if you're going to be able to pay it off, that's probably not the path that you should be going down, because it's only going to compound whatever problem that you might have. But as long as you utilize it responsibly, I think it can be a great tool.
That's amazing. Thank you. Well, we're nearing the end of our discussion about the building blocks of credit. But before we do, I'd like to hear again from you experts. Do you have any closing remarks, some comments or stories to share with our listeners before we wrap this up? So, Danielle, why don't we start with you? And Brandon, I'm including you in this. We want to hear from you too. But Danielle.
I would just like to say to everybody not to give up. If you are applying for credit and you are scared because you might have bad personal credit, but the lending game is changing with the rise of the fintech landscape. There are more options than traditional banks out there that you might be able to qualify for. There are grants, and there's also other methods of financing that you could look into. So there are also other ways to look into financing, so don't give up.
That's great. Thank you. Adam?
Yeah, to add to that, I think knowledge is power, and your personal and business credit reports are something that you can actually obtain for yourself to see where you stand. Sometimes you can find out a lot of great things about your business that way that you may not have realized before. You might not have realized what impact it has on your credit. So I'd suggest as a first step, if you want to fix something or you want to know where you stand, you can order your credit report, your personal credit report, for free directly from the credit reporting agencies. And then just as a final note, everything can be fixed, even bankruptcy, as Brandon alluded to with the current president down south. It's certainly not a hindrance for life, and it's certainly something that no matter what it is can be fixed with the right disciplined approach. So as Danielle said, don't give up, and yeah.
Thank you. Brandon?
Yeah, lot of feel, but absolutely. I echo all those comments. Give up. You have every capability in the world here to help you out. And the only other thing I'd probably lean on is if you're early, if you've enjoyed this conversation, and if this is something that's very important to you, the number of free online resources that will help you understand personal credit and how credit and revolving credit and all these terms operate is plentiful. There are excellent blogs out there. There are amazing startups that are creating entire books for free. It's a marketing strategy, but that doesn't devalue the quality of those assets. Give them your email, read them. You can learn so much.
I love that. I think it's so important to get informed and to use all of the resources that are available. But I also think it's important to talk to your network too. Find out what other people are paying. This is kind of follows up on what you were talking about, Brandon. Like, have those conversations and gain that information. So thank you to our guests. What a great conversation today about the building blocks of credit. Join us next Thursday, May 4th, when we discuss Founders' Lessons You Need to Know with host Paul Stevenson and Tuan Nugent, and with guest experts Shauna Traguna and Steve Bouchain. You can register for this event and more at startupcan.ca/events.
You can also stay informed of all the latest opportunities, announcements, and entrepreneur events following Startup Canada on Twitter, liking us on Facebook, and following us on Instagram. Remember, it's inclusive, all three. A new #Startup podcast drops every Tuesday on iTunes, and Startup Canada Live is here on Periscope, Facebook Live, and Event Stream every Thursday from 12 to 1 Pacific Eastern Time. To everyone who joined us today, the entrepreneurs, our startup community leaders, broadcast viewers, thank you for having us, and I hope you have an enterprising week.
Thanks, everybody. It was a great conversation. And we look forward to continuing it. Until next time, bye-bye.